So welcome back to objective 2 of chapter 5. This chapter, or excuse me, this objective, we're going to start doing those journal entries. So again, if you have access to a printer, I really encourage you to go through and print out those handouts. You want to really engage with the content. I promise that's going to make it stick in your head so much easier and so much better. So as we start going through all of these journal entries, don't forget, pause the video, try to work the journal entry out on your own, and then resume the video and check your answer and listen to my explanation. But it's really important that you engage with the content. So we're going to go through and look in this objective at purchasing inventory. So before we can sell it, we have to purchase it. So we're going to purchase inventory in a perpetual inventory system. Now, first thing when we buy something, we're going to get a purchase invoice or something like that. In other words, a sales receipt of some sort, but it's really a more detailed receipt. So this is buying it from the seller, and we are the buyer here. Now, part of what is hard about these journal entries is keeping track of who you are in the transaction. In these transactions, we are the buyer. In objective 3, we'll be the seller. So it's important to keep your perspective straight. But when we buy something, we are almost always, not always, but almost always going to buy it on account because we've set up these contracts, these agreements with our sellers. So with our suppliers. So a couple of things that we want to point out, and remember we talked about earlier in chapters 2 and 3 that it's important that we always have a paper trail. So we want to keep this purchase invoice as evidence. The auditors will want to see it when they come in to audit. So a couple of things. Notice first of all the date. Dates are important. We'll talk about dates a little bit more in a while, but dates are very important. So the date of the invoice. Notice also it tells us exactly what we bought, how many we bought, what the unit price was, and what the total was. In this case, they did not charge any shipping or handling or sales tax, but if they had, that would be on there. We'll learn how to deal with that. And then the other thing that I want to point out, and we're going to come back and touch on this one in a little bit, just a few slides, are the credit terms. So just kind of stick this in your mind that the credit terms we're offered are $315 net 30. So here we're told that we received the goods from that sales invoice on June 3rd and we made the payment on that date. So since we are the buyer, we received the merchandise. This merchandise is our inventory. Inventory is a current asset and assets have a normal debit balance. So I want to debit the inventory account for, in this case, $35,000. So I debited inventory, and since I'm told that I paid for them at the time of sale, I'm going to credit cash. Now, if we didn't pay for them at the time of sale, if we said, hey, we'll pay you later, then we would not credit cash. We'll look at that in a minute. So in this example, assets went up, inventory went up by $35,000, and assets went down, cash went down by $35,000. Now assume instead of paying cash for that inventory, we purchased it again on account. Now we know that on account can mean accounts payable or accounts receivable. So we got to figure out which one it is here. Since we are purchasing, it's always accounts payable. I want you to keep in mind accounts payable and purchasing go together. So now we're going to make the exact same entry that we made on that previous slide, except instead of crediting cash, we're going to credit accounts payable. So we've debited our asset inventory to increase it, and we've credited accounts payable. Now notice, and we'll talk about this more when we get to chapter 8, so I'm just pointing it out now. Notice that we said accounts payable dash Southwest Electronics Direct. In other words, the vendor that we bought it from. We're going to have lots of vendors that we're buying from, and it's important that we keep track of how much we owe Southwest Electronics versus how much we owe Northwest Electronics, or so on and so forth. So we really have a bunch of little bitty accounts payable payable accounts, one for each vendor that we owe money to. And we call those subsidiary ledgers or subledgers, but we'll talk about those more in chapter 8, sorry. Now, there are times that we need to return some of the goods that we bought. So a purchase return is when we are the purchaser, and so we purchased some goods that were damaged or defective or whatever, and we returned them to the seller. Sometimes we'll call up the seller and we'll say, hey, you know what? Some of these goods that we received, a little cracked or the box is bent and I can't really resell this. It doesn't look very nice. I want to send it back. And they'll say, you know what? You just go ahead and keep them and we'll give you your money back. Okay, that's called a purchase allowance. So a purchase allowance is, again, when we physically keep the good, but we get our money back. So here we're told on June 6th, we returned 20 tablets from that June 1st purchase because they were damaged in shipment. Now remember, each of the tablets costs $350 a piece. So 20 times 350 is how we get the 7,000 here. So it was 20 tablets at $350 each. So when we bought the tablets, we debited inventory and credited accounts payable. So now that we're returning the tablets, we're going to do the exact opposite. We're essentially going to flip-flop that entry. We have fewer tablets now because we've returned some, so I want to credit inventory. And then I'm going to debit my accounts payable account because remember, accounts payable is a liability and liabilities have a normal credit balance. So since I've returned some of these, I don't owe for them. I owe less money now. So I'm going to debit accounts payable to reduce my accounts payable T account. So if we look at our T accounts down here, we had originally credited accounts payable for $35,000. Now I've debited it for $7,000. So now I show, hey, I only owe $28,000. And my inventory, which I originally debited for $35,000, but now I've credited for $7,000 because I returned this inventory. Now I show, hey, I have inventory that cost me $28,000. Now, let's go back to that 315 net 30 that we looked at earlier on the invoice. This is called a purchase discount. So we had worked a deal with Southwest Electronics. We said, yeah, we'll pay you later. And Southwest Electronics may offer us what is called a purchase discount. This is an incentive to pay early. So the way this reads is we read it to say 315 net 30. The net 30 days is when the bill is due. So we owe $35,000 in 30 days. But they're offering us a discount if we will pay early. This is the first number, and these numbers will all change, but the first number in front of the slash is the percent of the discount. So in this case, they're offering us a 3% discount. The number after the slash is how many days we have to pay in order to get the discount. So if we pay within 15 days, so by June 15th, then we can take a 3% discount. Otherwise, the full amount is due in 30 days. Now, these may change. It may say 210 net 30. It may say 320 net 45. Sometimes you'll see it as 110 EOM, where EOM stands for end of month. So that means it's due by the 30th of the month or the 31st, the last day of the month. Either way, you're going to read it the same. The first number is the percent discount. The second number is the number of days you have to pay to get the discount. And then after the comma is when the full bill is due. So remember that I only owe $28,000 because I returned $7,000 worth of goods. So I actually only owe them $28,000. So since they offered me terms 315 net 30, that means that if I pay by June 15th, which is 15 days after the June 1st invoice, that I would get a 3% discount. Now, how to calculate the discount, there's two different ways that you can calculate this mathematically. I'm going to show you both ways and let you choose which way makes most sense in your head. So method number one, I'm going to write these up here. If I owe $28,000 and I receive a 3% discount, then I can multiply 28,000 by 3% or 0.03. Remember to convert a percent to the decimal, you move the decimal 2 places to the left. And that means I would get a discount of $840. So if I get a discount of $840, that means that I would owe $27,160. That's what I would have to pay when I wrote the check, assuming I wrote it by June 15th. Now, the second way to calculate this discount is to say, all right, look, I owe $28,000, but remember they gave me a 3% discount. So if I am getting a 3% discount, then you can think of it as I actually owe 97% of the bill. So I could multiply 28,000 by 97% or 0.97, and it would show, hey, I owe $27,160. So either method works mathematically. They're the exact same. You just do whichever method makes the most sense in your head. So here we're told, we've already done the math here. We know that we get a discount of $840 and we owe $27,160. So assuming we paid before June 15th, we would pay $27,160. So in my journal entry, I would credit cash. So I'm going to write this down here with us and then we'll check our answer. So I am going to drop down here, skip a few lines, indent, and I'm going to credit cash for $27,160 because that's how much I owe. Okay, that's how much I'm actually paying. Now, when I pay a debt, I've credited cash. I want to debit accounts payable to reduce my liability to show, hey, I don't owe them this anymore. So hopefully you still have your T account written down in your notes there, and you notice that accounts payable has a credit balance of $28,000. So if I want to reduce that liability, since liabilities have a normal credit balance, I want to debit accounts payable. Now, it may be tempting to want to debit accounts payable for $27,160, but if you do that, you're going to show a balance in accounts payable of $840 credit. That's going to look like we still owe them $840, but we don't owe them $840. We owe them zero. We have zeroed out our account. So I want to actually debit accounts payable for the full $28,000. I want to debit accounts payable for the full $28,000 there to show, hey, I've zeroed out this account. Now when we post this, accounts payable is going to have a zero balance in it. But we know that debits have to equal credits. And right now my debits and credits don't equal. I have 28,000 of debit, 27,160 of credits. So that means I'm missing an $840 credit to some account. Now, this credit represents the discount. It represents the amount of money that I saved on my inventory. Remember, inventory is an asset. All assets are recorded at their historical cost. So if you look in the inventory account right now, it shows a balance of $28,000, but that's not actually how much the inventory cost us. The inventory is actually costing us $27,160 because I got a discount. So I want to credit the inventory account for $840. I want to credit the inventory account for $840. I'm going to erase this and show you the real journal entry here. For $840, now when I look at my inventory T account, it will show the $27,160, which is what I actually paid for the inventory. Accounts payable will be 0, and inventory will correctly be recorded at what I actually paid for it. So let's look at these T accounts on the next slide here. So my cash balance, but notice inventory now shows the 27,160, and accounts payable shows that 0 balance. So I've zeroed out my account with them. So it's really important. You want to star, highlight, triple underline that one in your notes. It's important that you remember this because in a little bit in Objective 3, we're going to cover sales discounts, and sales discounts are different. Okay, this is a purchase discount. This is when I am the buyer. So purchase discounts go as a credit to inventory, not sales discounts. So keep that straight in your mind. Okay. So assuming that we didn't pay until after the discount date, then when we paid, we would just debit accounts payable, credit cash for the full 28,000. So if we didn't pay by the 15th, then we forfeited our rights to the discount. We just had to pay the full 28,000 that we owed. Now, let's talk about transportation cost. In the example we looked at, remember, we weren't charged any shipping cost, but it's not unreasonable to think that we will be charged shipping cost. And certainly when we're the seller, we will have to pay shipping costs, whether we charge those to the customer or whether we offer the customer free shipping, which doesn't really mean it's free. It just means the seller is paying for the shipping cost. So how we record those depends on who pays for them. So if the seller, let's start on the right, if the seller pays for the shipping cost. So if we are the seller and we pay for the shipping cost, or like Southwest Electronics offered us the shipping for free, which means they paid the shipping cost, then those goods are considered to be shipped what's called FOB destination. FOB stands for free on board. What this means is the seller owns the goods while they are in transit. The seller owns the goods until UPS or FedEx or whoever sends them a notice that says, hey, we've delivered these goods. So that is what's called freight out. And freight out, as we'll learn in Objective 3 in a minute, is a regular operating shipping expense. So I'm just going to write this one over here. This is, again, what we call freight out. But if the buyer pays for the shipping cost, in other words, the seller passes that on to them and the buyer pays for the shipping cost, then those are considered to be shipped what's called FOB shipping point. That means the buyer owns the goods while they are in transit. So if you buy something, as soon as you pay the shipping cost, that means as soon as you get that notice that, hey, these have been shipped, you legally, contractually own them, even though they are not in your possession, even though they have never been in your possession, you have never received them, you still technically own them. Okay, so that's important. They're included in your inventory account, even though you haven't gotten those goods yet. And this matters really, and as you get into upper level accounting classes, you'll talk about this a lot more. Now, if you have to pay the shipping cost as the buyer, this is called freight in. Freight in is not an expense. Remember, inventory is an asset and all assets are recorded at their historical cost. Specifically, that cost means everything we have to pay to get that asset ready for its intended use. So if we have to pay shipping, then that's part of the cost of the asset. So freight in is actually a debit to inventory. So freight in goes as a debit to inventory, whereas freight out is just an expense. If you have to pay sales tax, then that's part of the cost of the goods, so you debit inventory for the for the sales tax also. Think of it like this. If you go to the store, or let's say that you're ordering something online, you want to order a shirt that's $10, okay? But so you're like, ooh, great, this is a great deal. It's a $10 shirt, woohoo. But you have to pay $1 in sales tax, and then you have to pay $5 in shipping. Well, this shirt didn't cost you $10. This shirt cost you $16. So you're going to record that asset at $16, at the full amount that you had to pay in order to get that asset, not just at the selling price of $10. So here we're told that we have to pay $60 in freight, and they were shipped FOB shipping point, which means we paid for them. So again, we're going to debit that inventory account and credit cash, or it could be accounts payable depending on how we paid for those shipping charges. Now, if sometimes the seller will prepay the shipping cost and then they will put it on the invoice with us. So for example, we purchased $5,000 worth of goods, and then there's $400 of freight charges tacked onto that, and we got some discount terms of 3/5 net 30, which means we get a 3% discount if we pay within 5 days. So in that case, we would debit inventory for the full 5,400, the 5,000 of goods plus the 400 of shipping, and we're going to credit accounts payable for 5,400. Now, assuming that we pay within the discount period, we're going to take a 3% discount, but not off of the full 5,400. We don't get the discount on the shipping. We only get the discount on the goods. So we'll take a 3% discount off of 5,000, which is $150. 5,000 times 0.97 is 4,850, or 5,000 times 0.03 is $150 discount. And then we'll pay the $400 on top of that. So in this case, we would debit accounts payable for the full 5,400, we'll credit cash for the 5,400 minus the 150 discount, and then we'll credit inventory for the 150 discount also. Now, when we talk about the net cost of inventory, this is basically that giant inventory T account. It's the cost of the inventory, our purchase price, minus any purchase returns or allowances, minus any purchase discounts, plus any freight. So if we look at this in our inventory T account here, we debited inventory for the purchase cost. We credited inventory for purchase returns and allowances. We credited inventory for purchase discounts, and we debited inventory for freight in. And so that would give us what's called the net cost of inventory, or the net amount of what this inventory actually cost us.